My name's Ethan Braid. Today we're going to talk about the ridiculous housing bubble that we're all dealing with. First, we're going to look at how to quantify definitively the amount by which this housing market is grossly overvalued. I can show you a simple way to calculate just how much of a bubble we're actually in. And then we're going to look at one of two ways that this bubble might deflate. We're going to be using two data sets to quickly calculate how much this housing market has deviated from the norm, i.e. how much of a bubble are we really in. This graph comes from the Federal Reserve Bank of St. Louis. This is for the median sales price of houses sold in the United States. And we can clearly see this massive 50% jump in prices once the Fed started handing out money like candy during the COVID pandemic. Now, to quantify just how much of a bubble we are truly in, we are simply going to take the median sales price of a house in 2024, compare that to the median family income of $92,750, and then we're going to compare that number, the ratio of those two numbers, to what the average has been over the last 50 years. Let's take a look. Here's your proof that we are definitely in a bubble for housing. Here we are in 2024, median price $417,000, median family income $92,750. That's a price to income ratio for your standard median home of 4.5. That compares to the average. Here I've listed the decade by decade average going back 50 plus years. 3.2 is the long-term average when you compare median home price to median family income. Now let's put those affordability measures of 4.5 and 3.2 into simple terms that everyone can understand. In order to get back to the long-term average affordability of 3.2, your income needs to go up by 41%, or home prices need to drop by about 30% or over $120,000 for your typical median home. That's how significant this problem is. We are grossly overvalued to the tune of about 30% for the real estate market, and the real estate market needs to drop by 30% just to get us back to the long-term average. Let me show you the simple calculations. To get us back to the long-term average affordability of the last 50 plus years pre-COVID, where we were at a 3.2 ratio of median price to median family income, either prices need to drop by 29% or income needs to jump by 41%. This is just simple algebra here, folks. If you pause this video and just take a look at what I did here, you can see how I made the calculation. It's very simple. But at the end of the day, either prices are coming down or income is jumping up. One of these has to happen to get us back to the long-term average affordability and end this bubble. Now, I can't predict if we're going to see a 30% drop in housing prices or a 41% jump in wages. But I do think that it's important to identify where we are at in the business cycle. And it is obvious that we are in a bubble. This reminds me of the year 2000 when we were experiencing the dot-com craziness. This is the same thing, only I believe it's a lot worse, because unlike the dot-com tech mania, where only people who had extra money could gamble in the stock market, this bubble affects every citizen in the United States. We're all in this together. And unfortunately, there are a lot of people, many realtors out there just pushing the hype and fanning the flames. Of course, they want to see prices go higher, right? Everybody does who is in the trade. And I'm talking about REITs and hedge funds, and unfortunately even pensions like the Texas Teachers Retirement System. They own thousands and thousands of homes. It's crazy. Everybody's in this game, and so you have a lot of biased people out there who want to fan the flames and see the prices go higher, and they want the bubble to continue, right? All the people who are invested in multifamily housing, for instance, they just want to see it go higher and higher. Let's take a look look at how this bubble came to be. And so that will give us some clues about how it might unravel in the future. Cheap debt is a necessary ingredient for all speculative bubbles. What we're looking at is the long-term graph of the 30-year mortgage interest rate. And we can see that after the last recession of 2008, interest rates were artificially low for a number of years, thanks to the Federal Reserve. And then after COVID hit, interest rates dropped to levels never seen before, where the 30-year mortgage rate went under 3%. Low interest rates didn't just benefit the average consumer looking to buy a house. Here's an article from 2021 about the Texas teachers' retirement system. And essentially what this article is saying is that they're forming a $5 billion joint venture to buy more than 18,000 rental houses. And they're looking to do it with not just equity, but also debt. And that's because they and their partners were able to borrow money very, very cheap. And oh, by the way, they're looking to buy homes that are about $250,000. Sound like your average starter home? Sure it is. So when we had all this cheap debt out there, it wasn't just individuals buying the homes. We created a feeding frenzy for hedge funds, REITs, private equity funds, et cetera, et cetera. The primary reason that hedge funds, REITs, pensions, and many other types of investors piled on the housing market over the last decade plus was because of insanely cheap debt. They could borrow money at a very, very low interest rate and then turn around and rent those properties out for a return that was much higher than the cost of the interest. Now that mortgage rates are back up around 7%, investors can no longer borrow money cheaply and make a great profit by renting out single-family homes or even multifamily buildings. Now, for anyone who thinks that the solution to the affordability crisis for housing is to have interest rates come back down to make things more affordable, you're missing the white elephant in the room. The white elephant in the room is hedge funds, private equity groups, pensions, REITs, and others who are going to swarm back in if they can borrow money cheaply, and they will be competing with housing again. Single-family homes in particular, starter homes. So the solution is not to bring interest rates back down. That will only inflate prices further, make things more competitive, and continue the bubble. Fed Chair Jerome Powell is well aware of the fact that low rates are inflationary. And that is why he's now performing quantitative tightening. You can see that the mortgage-backed security position held by the Fed, that's the graph that we're looking at here, is being brought down in a very measured pace. And the reason that they are doing that is to prevent mortgage rates from going way back down again and creating more inflation. Also, you could take a look at this graph and you can easily see that this huge purchase of mortgage-backed securities right after the COVID pandemic started by Jerome Powell and his team was a big contributing factor to the housing inflation and the bubble that we're all living in. Here's a snapshot of total mortgage debt in the United States. Look at this explosion since the pandemic. Trillions of dollars of mortgage debt. Kind of throws shade on all the cash buyers, right? If everybody's a cash buyer, why are we adding trillions of dollars of mortgage debt? So to sum it all up, we're definitely in a bubble. I don't know how it's going to come apart. Are prices going to go down? Is income going to go up? I'd lean towards prices going down before income goes up. If we get a recession, which is very likely in the next 12 to 18 months, very high odds of that, given all the indicators telling us that a recession is probably not too far off. Unemployment picture could change very quickly. It always has, right? One minute you're at beyond full employment, and the next you're just watching hundreds of thousands of people lose their jobs, unfortunately. So if we tip into recession, that may have an impact and bring about supply. These high interest rates, coupled with more inventory, will bring prices way down real fast. The reality is that no one or very few people rather, can buy a home in this environment with prices so high and interest rates so high. And the Fed doesn't want interest rates to come back down, in my opinion, because that will create more inflation for housing. So they need to keep interest rates around that 7% level for a mortgage to prevent investors from flooding back into the market and from people buying more home than they should be buying or can afford. So we're really in a mess here. And how is it going to unravel? It's really hard to say. But I think that a price drop is the more likely of the two paths forward to get us back to average affordability for housing. The existing home inventory of 1 million homes for sale is way low compared to the 2.2 million long-term average. That low inventory is clearly what's holding up prices. But to me, it's all artificial. You have lots of people who are trapped in a house that they could not buy at today's prices with their current income. In other words, the home price has gone up so much, it's outstripped their income. It's outpaced their income. They couldn't buy it at today's price and today's interest rates, but they're living in the house and they're not going to go anywhere because they're trapped in a loan that they can't replace. Think about that for a minute. I know lots of people in this situation, and I'm sure you do too. Maybe it's even you, the viewer. You're trapped in a house. You could sell for a nice price, but if you have a loan, then you're trading one loan at maybe under 3% for a new loan at possibly 7 or higher. And you're going to have to pay transaction costs and move on to a higher price home. You may even have to take out a larger mortgage. So you're going nowhere. That's the reality for most people. Given the fact that there is such limited inventory of homes for sale, it doesn't take many buyers to make it look like the demand is off the charts and the housing market is going up and up and up. What I'm talking about are buyers who can buy under any market conditions and who won't be nearly as influenced or sensitive to price and interest rates. These would be people who have inherited money, people who are wealthy, people who are retiring and moving, people who are relocating for work, or people, unfortunately, who have gone through a divorce and received a settlement and need to buy a house. People in this group or these groups are going to make a transaction, they're going to make a purchase, and there are always going to be some of these people in the market. So what I'm saying is that I think the low inventory number is being held up by this relatively small group of buyers who are always present. And I propose that if we had a bunch of inventory came on the market and interest rates for mortgages stayed pegged around, say, 7%, then I think homes would come down in price rather quickly, maybe 20 or even 30%, because there are so many other buyers out there, people who want to buy a house, but they simply cannot afford a home at these prices. When the median home price is 4.5 times the median family income, there are lots of buyers or people who want to be buyers who just can't buy at these prices and these interest rates. So all we need is a bunch of inventory to come on, and then prices are probably going to have a pretty steep and fast correction, in my opinion. I'll close on this. I don't know when or how this bubble unravels. Our price is going to come down, our income's going to go up. I'm leaning towards prices coming down. I think that's much more realistic for a lot of reasons. But when will it happen? Maybe it doesn't happen, or maybe prices just stagnate for the next 10 years while incomes slowly come up, and that balances the market and helps bring about affordability. Look, none of us really know. I think the only thing we can be sure of is that we're grossly overvalued, and yes, we are in a bubble, but we don't know when or how it pops. So, for the family that's watching this video, or the person who's watching this video and thinking about buying a home, be smart and focus on what you can control. Don't go more than 2 times your income if you can do that. Otherwise, if you go 3.5, 4.5, 5 times your income, something crazy like that, if you really stretch yourself and you buy a big expensive home with an expensive mortgage, you will never be able to save for your own retirement, put your children through college, take a vacation, and handle all the unexpected things that happen in life, you're going to be very, very stressed out. And you know that you're already paying a ridiculous price. So to the extent that it's possible, try to live within your means. I know that's a message that a lot of people don't want to hear, and people get upset about that. But look, we're all going to have to sacrifice. This mess that we're in may go on for some time. Nobody knows. So I hope this video was helpful. I hope it gets you thinking about your finances and overall improve your family's financial plan.